The best way to make money, which are very less risky, get quality stock from Nifty 200, which are mispriced, and get into it. If you create a combination of both, you're here for a very long ride.
This is where the action is going to happen.
Now, Indian market is bottoming out. We believe it's a time when the good stocks will start performing from a 3 to 5 year perspective from here on. If you want to make money from 2025 to 2050, you have to shift from BRICS to VIPIC.
What is that?
VIPIC.
VIPIC. What is VIPIC?
VIPIC is...
So now as a retail investor, I have Indian stock market, then I have US market. But apart from these, is there anything else in the equity part for an Indian investor?
I think the most of the part which is most under talked about is ETF. I'll give you a mantra for mutual funds. For example, your age is 30. Then 30% of your portfolio should be into large cap. And that's 70% of your equity mutual fund portfolio should be in mid cap and small cap.
So what exactly is the thumb rules that I should follow for picking the best mutual fund in any category? Can you reveal that secret?
म्यूचुअल फंड सही है, लेकिन क्या आपके स्कीम सही है? There are more than 4,000 plus mutual funds in India. How many do you need? Ladies and gentlemen, welcome to another episode of the 1% Club Show, where we will unravel all the secrets behind getting best performing returns in your mutual fund investments. So make sure to watch till the end, because every second on this podcast is gonna be worth thousands of rupees. So Mr. Amit Jain, thank you so much for coming on this show.
Thank you, Sharan. Thank you for having me on the show. It's a privilege.
Thank you so much. So Mr. Amit, there are so many ads about mutual fund sahi hai. Sachin Tendulkar has come and told mutual fund sahi hai. But nobody tells us kaun sa scheme sahi hai. So my first question to you, Mr. Amit, is that how do I actually evaluate a mutual fund? Right? There are 4,000 options. How do I know what are the mutual funds that I need in my portfolio? So can you please break that down for us?
Absolutely, Sharan. I think we talked about the market crash in September 2024 when I was there on your show in the last time. And since then, I think Nifty has hardly given any returns.
Yes.
Right? So I think our team had been excellent in identifying that exit opportunity from Indian stock market. Right? So that was bang on. Now, we believe that Indian market is on the lower end of the bottoming out. We believe it's a time when the good stocks and good stocks portfolio will start performing from a 3 to 5 year perspective from here on. So that's a caveat we just want to put on, because last time when I came on your show, I said exit. Now we say enter slowly, start building a quality stock portfolio and build it for long term. There are a lot of opportunities crying buy in Indian stock market at this moment of time. So that's for stock market.
So you're saying now is a good time to invest in the markets
Absolutely.
Again? Indian markets.
Indian market. Now it's almost a year since we exited Indian market. But I think we are finding that euphoria has settled down into Indian market and the valuations are very reasonable. US market is trading at a very high level, at a very premium level compared to Indian stock market. And that difference is almost 17-year high. So we are coming up with a new theme now, which we says that it's a time to move from NASDAQ to Nifty, which is from US stock market to Indian stock market. That's a theme which we are believing in nowadays.
Everyone's talking about how AI is taking over jobs, but the truth is, it's creating way more of them. Roles like AI product manager and prompt engineer are everywhere right now. This episode sponsored by Coursera, a platform trusted by millions to learn from the world's best. Go on to the link in the description and you'll find their AI courses like prompt engineering for ChatGPT, Google AI Essentials, and AI for Everyone. These teach you real, job-ready AI skills that help you move from just using AI tools to actually building and managing them. Coursera also has a full range of generative AI courses. These go beyond the basics and dive into LLMs, prompt engineering, AI product workflows, and real-world Gen AI applications. And these are taught by experts from Google, Microsoft, IBM, Meta, and more. So you learn how to move from understanding AI to actually creating and deploying AI solutions. Now about the pricing, with Coursera Plus, you normally pay $13,999 a year. But right now, as part of their holiday promo, the annual subscription is just $7,999. You save 40% and get unlimited access to courses from Google, Adobe, Microsoft, IBM, and many others. It's a limited time offer And it's not a big amount when you think about what it gives back. Future-proofing your career and keeping you ahead of the curve. Your next big opportunity might just need one new skill. So go check out these AI and generative AI courses on Coursera with the link in the description.
Coming to your second question, that mutual fund सही है, पर क्या आपका mutual fund scheme सही है? I think there are 3-4 factors which you have to keep in mind.
Sure.
Number one, you should talk about it that whenever you invest, you should be very careful that what kind of scheme you want to invest in. Because in mutual fund, you will find a lot of options. Number one, there are large cap schemes, mid cap, multi cap, flexi cap, and thematic schemes. So ideally, you should balance out all the schemes in a proportionate way, right? For example, large cap. I'll give you a mantra for mutual funds. So whatever your age is, for example, your age is 30, then 30% of your portfolio should be into large cap. And that's 70% of your equity mutual fund portfolio should be in mid cap and small cap.
Interesting. So I'm 30 years old.
Yeah.
So you're saying 30% of my money should be in large cap companies.
Yeah.
And 70% in mid cap and small cap.
And quality mid cap and small cap. Whenever I say any large cap, mid cap or small cap, they have to be quality stocks. As your age move forward, for example, you become 40, then your large cap should be 40 because you need more safety.
Right.
And large cap come with a lot of safety.
Right. So
mid cap and small cap come with a little lesser safety because as you grow up, right, you want lesser risk.
Correct.
So that's the way it should be progressive for your mutual fund portfolio.
Got it. So as you grow up, you're saying as you grow older, the large cap allocation should be more and more, and the mid cap and small cap allocation should reduce.
Reduce, absolutely.
Now you mentioned a point that you're talking about quality companies when you're investing, meaning they should not be just any random large cap, mid cap or small cap. Now, as a retail investor, I don't have the time to do all of this. I have a 9-to-5 job. After I come back home, I don't have time to do all of this research. How do I know what is a good quality mutual fund within a particular category?
As you said, you are in a 9-to-5 job. Please focus on 9-to-5 job and please outsource it to some advisor who knows his business very, very well. Okay. As on today, when we are talking on your podcast,
okay,
if you search and go to advisorcoach.com or valuesearchonline.com, right, you will find the best scheme in large cap mutual fund category is giving you a return of 12%.
Okay, this is last 1 year returns.
Last 1 year returns.
Okay.
And the worst scheme is giving you minus 1% return.
What? A 13% difference between the best and the worst?
Worst.
In the same category?
In the same category.
Okay.
And that's only your advisor can help you out if you got the right advisor, because that's where it differs. Because generally I've seen there's a euphoria into direct plans nowadays, but direct plans are good if you know the trade well.
Before I go into that, I wanted to know, is this kind of a big difference only in large cap or also in other kinds of mutual
funds? Even higher in mid cap and small cap. To give you an example, in small cap, today, the best mutual fund scheme is giving you 8% return in last 1 year.
Okay.
And think of worst.
I don't know, 2%?
No, it is minus 12%.
Minus 12%?
In last 1 year. So the best small cap fund in last 1 year in that category of small cap funds is giving you 8% return.
Okay.
And the worst scheme is giving you minus 12% return.
Okay.
And only your advisor who is capable, who knows stock market well, who knows his subject well, who knows stock market well, can help you out to identify those schemes, that which scheme is going to perform well in next 1 to 3 years, because they understand the market well, while you are into 9-to-5 job. You understand your job well, let them do their job, because that's where you can make an alpha on your portfolio.
So basically, if I put 1 lakh rupees in the best performing small cap fund, it would have become 1,08,000. But if I had picked the worst performing small cap fund, it would have become 88,000.
88,000, correct. So 88,000 to 1,08,000. It's a 20,000 variation.
Wow.
Or you can say 20% variation.
So if I had to kind of look at the mathematics here a little bit, right? If I have to get a trustworthy financial advisor to help me, now typically this comes in the form of commissions, right? And that is why the entire finance industry in the last 5 years have been saying, get away from regular funds and move into direct plans. Right? This has been the number one marketing line of all fintech companies in the last 5-10 years. Exit regular, go into direct plans. Because in direct plans, you have 0% commission. But from what you're telling me, that if I'm investing in direct plans, and if I'm doing it by myself, the variance of me making it wrong is anywhere from 10 to 20%. The
True.
difference.
True.
That
You're
if I get it
absolutely
right, I'm getting 20% higher, but if I get it worse, I'll get 10-20% lower returns. And if I get a trustworthy advisor, what I'm paying them is typically 0.5% or 1%. So what you're saying is that if I pay that 1% commission, but if that advisor is helping me get that additional 5-10% returns, then it is worth it, right? Versus me doing it by myself.
Absolutely.
That's the way to look at
it. Honestly, in a little lighter mood, I always say it's a penny wise, pound foolish.
Right.
So मैं पैसे तो बचा रहा हूँ as a retail investor,
right.
but pounds उड़ा रहा हूँ, right? So that should not be the way, because the only thing is you have to have that right advisor to whom you can trust. You can trust his integrity. You can trust his skills and capability as well, right?
But then the problem, Amit, is that not everybody watching this has 100 crores to take your help. So can you reveal some of your secrets? Because you mentioned that the difference between the top performing fund and the worst performing fund can be as high as 20% also.
Yeah.
So what exactly is the thumb rules that I should follow for picking the best mutual fund in any category? Can you reveal that secret?
So generally we don't see the past performance, number one.
Oh, really?
We just learn.
No past performance?
Not at all. It doesn't matter.
Wow.
Okay, I'll give you an example in real estate and gold. Okay, take it in real estate. You are aware of Delhi?
Yes, I'm aware of Delhi.
From 1980s to year 2000, the old Delhi area called Chandni Chowk and that area, the Wall City area, or even Nariman Point, has given the greatest return on real estate.
Okay. How much?
And I think they have given, 50 times in 1980s to year 2005, 2004. They have given 50 times return on real estate side. I'm talking about the Wall City area in Delhi, right? If anyone who is investing into 2005 and seeing that past track record, that Chandni Chowk has done the best, it has given me 50 time return.
Right.
I should invest into Chandni Chowk in 2005.
Right.
In last 20 years, this guy has not made even a single penny.
The real estate in Chandni Chowk.
Chandni Chowk.
Okay.
It is stagnated for last 20 years.
Wow.
Right? On the other hand, if the guy would have moved from Chandni Chowk to Gurugram in last 20 years,
right,
the return would have been 20 times again.
Right.
Return would have been 20 times again. That's where the switch time comes in picture. So we generally analyze that if something has done very, very fast, is it saturating? Has the ecosystem around that asset class is saturating? Or where is the emerging trend of growth? So we always invest on the future potential rather than going for the past performance. So we don't do it, number one.
Got it.
Number two, we never go by the AMC, whether it's a SDFC AMC or ICICI Pru AMC or it is Reliance or any AMC. No.
Doesn't matter.
Doesn't matter at all.
Okay.
What we do is, because we are a we have a stock services as well as one of the business vertical which we have a great team of research analysts.
How many people are?
I think it's around 35.
35 people doing full time.
Full time.
Okay.
For doing it. We have a staff of 300 people across the board.
Okay.
But 35 are in research entity across the group.
Okay.
Right. So what we do is we have a list of stocks which we feel are bullish from next 3 to 5 year perspective.
Oh, okay.
Okay. We know the stock because we keep reading a lot of stock market research reports. We keep doing it, right?
Sure.
And we take out which scheme is having those stocks in their portfolio. So rather than it's a Reliance AMC or it's a ICICI AMC or SDFC AMC, it doesn't matter. We just see that these stocks are going to perform well. These 20 stocks are going to perform well in next 1 year.
Okay.
We only choose those schemes which has these 20 stocks. So it's a bottom to top approach rather than top to bottom approach. Because generally what people see is ICICI Pru का म्यूचुअल फंड है, अच्छा ही करेगा. ICICI Pru के तो 100 से ऊपर स्कीमें हैं, सभी अच्छा नहीं करते हैं.
Correct.
Right? उसमें 100 में भी आपको चूज करना पड़ेगा ना. You have to choose something. Right? So what you can do is you should be very clear on your theme and stocks on which you are bullish on, and try to see that on the stock on which you are bullish on, which mutual fund scheme carry those stocks.
So then why don't I just buy those stocks myself?
Ideally, you should. So honestly, that's a new theme which we at least practice in our family office, and with a close circle of friends and families.
Okay.
That we create an alternative of different asset class. For example, mutual fund carry 50 to 60 stocks in a scheme.
Okay.
50 to 60 stocks in a mutual fund schemes. It is good for investor. It is bad for investor as well. It is good because it carry a lesser risk.
Okay.
It is bad because it diversify your potential return as well. Because if you take in next 1 year, out of those 50 stocks, maybe 20-25% will be higher. 20 to 25 stocks will remain at the same price.
Okay.
And 10 to 20 stocks will be on lower side.
Okay.
So overall portfolio return will not be great for you. Because there are 60 stocks and you cannot take out 60 stock in one go which are going to perform well for next 1 year. Trust me, it's difficult.
Okay.
Because sometimes some sector will work out, sometimes some theme will play out, sometimes the PSU theme will play out, which no one expected, like PSU Bank has added suddenly out of nowhere.
Right.
Somewhere the railway stock will start burning out, so will blow out. Sometime fertilizer stock will blow out. Some theme will play out.
Right.
So if you have a 60 stock portfolio, it is impossible that all 60 stocks are going to perform in next 1 year.
Okay.
Right? So that's a problem because it diversifies your return. Now, how to solve this problem? Within Nifty 200, you find lot of mispriced stocks at times. For example, on last podcast with you, we had a Precap stock which was mispriced around 1120, which we talked about.
Right.
Now it is 1500. Right. So if someone had invested into that stock with the right allocation, right, he would have made 40% versus Nifty of 3 to 4%.
What do you mean by mispriced?
At times what happened, that market don't see fundamental. Whenever there is a panic in the market, people just press a button called sell. And that moment of time, you'll find a lot of stocks which start trading below their intrinsic value.
Okay.
Right?
Intrinsic value is their true value.
True value. For example, that Precap stock, which has fallen from 1500 to 1100 in a span of 3 months, was not the fair value for that. It has to come to its fair value, which has come.
Right.
At some point of time, we find out one of the FMCG stock, which was mispriced. We invested in that mispriced FMCG stock and made money for us. So the point is, you have to find out mispriced stock within Nifty 200, which are the quality stocks. So the point is, 60 stocks on one side and 6 quality stock on one side will always win and create an alpha in a longer run for you.
So just to summarize what you said first is when you evaluate a mutual fund, you don't look at the past returns. You are looking at the future potential.
And for you have to, I'll just barge in between. You have to see the quality of stocks and their future potential.
Got it.
Because as I said, Chandni Chowk to Gurugram.
Yeah.
You have seen Chandni Chowk. It has worked for 20 years, but last 20 years they have not worked. And in 2005, if you invested into Chandni Chowk, you would have lost your money in last 20 years rather than making money. But anyone who would have invested into Gurugram or shifted from Chandni Chowk to Gurugram, he would have made 20 times of their capital.
Right.
So underlying stocks need to be screened well through.
So your team does that screening?
Yeah, we do that.
You guys look at all the 6,000, 7,000 stocks. You identify which are the top 30 stocks. Then you see which mutual fund scheme has those stocks in a higher weightage.
Absolutely.
And then you invest in those mutual funds.
Absolutely.
Right? So now as a retail investor, so I have so many options, right? I have Indian stock market. Within that, I have large cap, mid cap, small cap. Then I have US market. But apart from these two options, is there anything else in the equity part for an Indian investor?
I think the most of the part which is most under talked about is because no one make brokerage of fees there. That's an ETF.
ETF.
I think on your podcast last time we discussed the Hang Seng ETF where we probably
the Chinese index.
Chinese index ETF when we made 102% return in 9 months.
Wow, yes.
If you remember that podcast,
yes,
right?
You're right. I remember.
So ETF are the best way to have less volatile portfolio and higher returns. For example, today I would love to take tech ETF because I feel that the tech sector is giving me a great valuation from a 3-year perspective.
Of the US market?
Indian stock market.
Indian stock market. Okay.
But I will accumulate, not buy.
So, but there is IT sectoral funds, right?
Yeah, IT sectoral fund, but that fund will carry 2% fees.
Okay.
ETF will not carry that fees.
Okay. But there is no ETF in India for that.
There is an ETF. Say ICICI Prudential, every company has an ETF.
It hasn't. It exists.
It exists.
Okay.
You can invest into these ETFs.
Okay.
And which will cost only 20 paisa.
20 bips.
And you can hold on for these ETF and make money in the longer run. You have to identify the undervalued ETF and play for a longer run. The best way to make money, which are very less risky, get quality stock from Nifty 200, which are mispriced, and get into ETF. If you create a combination of both, you're here for a very long ride with a lot of safety.
No, but then between ETF and mutual fund, how do I decide then?
So ETF and mutual fund, of course, you can take a combination of it.
Okay.
I'll rather say a combination of Nifty 200 stocks and ETF. So you're creating your own mutual fund.
Got it.
As I said in my last answer.
Interesting.
Because that will give you a lot of safety. Nifty 200 stocks, generally safe. It's the top 200 companies of India. ETF are generally a combination of 6-7 stocks, which is again a safe.
So
you get safety and return as well in the longer run. And without any having 2 and 2.5% fees unnecessarily.
Got it. So, you are a global investor, Amit. So you're looking at everything.
Yeah.
You're looking at all countries, all economies. Now, as somebody living in India, all I'm noticing is Indian market, US market. Now, you just mentioned about the Chinese market also as a potential play.
When we did.
Right. So, as of now, there are 190 companies in the world. Is there any other country that is any of interest to you as a global investor, where you're like, hey, something interesting is happening in this African country or in this South American country where nobody is talking about and I should invest my money? Because today it has become possible to invest in the ETFs of a lot of countries. But as a normal Indian investor, I'm not aware because I don't have that much time I don't have time to read about my own country. Where will I have time to read about other countries? So because you're doing this as a full-time job, is there any such options out there apart from India and US?
So, recently in my interview, I said in year 2000, Goldman Sachs has come up with a term called BRICS, which is called Brazil, Russia, India and China. They formed the acronym called BRICS. And now it is no more year 2000. It is 2025. If you want to make money from 2025 to 2050, you have to shift from BRICS to VIPIC.
What is that?
VIPIC.
VIPIC. What is VIPIC?
VIPIC is it's again an acronym of countries.
Okay.
But we are moving away from BRICS to VIPIC. What we call is Vietnam.
Okay.
Indonesia.
Okay.
Philippines.
Okay.
India.
Okay.
And China.
This is where the action is going to happen.
Absolutely in next 25 years. So you have to move from, you have to sell West. And you have to again invest into East. And I'll not be shying away by saying on your podcast, the time has come when the sun will again rise from the East. I was in US and Europe for last 6-9 months, as you are aware of.
Right.
After Indians, if any country citizens are ruling the world in terms of the service industry, is Philippines.
Yeah, actually, when I used to hire from Upwork about 3-4 years back, this is a place where you can hire freelancers all over the world. Obviously, I didn't have money that time, so I used to put a filter, cheapest to highest. So the cheapest was always from either Philippines, Bangladesh or Pakistan. These are the 3 countries. So there the labor cost is the cheapest. Due to which that arbitrage opportunities are available for a business.
And they have hunger. They want to grow. They still have the same family culture. They want to save. They want to build their economy.
Right.
What Indians has done in the last 30 years.
So would you say this is the reason why Europe has slowed down? That they are already rich and they're like chilling?
So Europe has slowed down for last 20 years. I don't know how much. We studied this market very, very well. And trust me, I'll give you a very interesting example. I spent 2 months in London. I met 82 fund managers.
Okay.
And I told them that last 25 years, your economy has not done well. Your stock market CAGR is less than 3%. Less than 3%. Do you think that your economy has actually bottomed out and there are some value investing opportunities in your country? Out of 82, almost 70 told me no. Rather, they asked me, Amit, how we can invest into India. So it's the other way around.
Right.
Europe is facing a structural issue of demographic and culture. And it's all because of the culture, what they follow.
We work harder than them.
Absolutely. We don't have a weekend culture. We work hard. We have hunger. We have We still have a family system. We still think of next 7 generation savings. They even don't think of next 7 months.
Correct.
How you can build an economy? Can you build an economy on credit? No, you cannot. What makes you richer? Your saving or your credit or your loan?
Your savings.
Your savings. So that culture is differently. So even after 25 years of underperformance, I don't believe that Europe is going to get out of doldrums. Ultimately, you will find European Union, there are very high chances, will get disintegrated like USSR of 1993. It may take another 5 years, but it is going to happen soon because the culture and that demographic challenges what they are facing in terms of their population growth is going to do it next time. So we'll stay away from Europe. We'll rather bet on Southeast Asian countries like VIPIC and make money for next 25 years.
No, but that's great that VIPIC strategy is there, but there are no mutual funds in India where I can invest in VIPIC countries. So how do
Not as of now, but I think you can invest into Chinese ETF. I told you that Mirai has that Mirai Tech Fund where we invested. Right? And it was up 102% return in last 1 year.
But that is exposure in Chinese companies.
Chinese companies, Chinese tech companies. Because when we took that exposure on 23rd March 2024, when I talked to you, right, the Nasdaq was trading at a PE of 30 and US tech stock was trading at a PE of 7. And I am not a believer that China is behind US by any standards in terms of technology. Right? So at a 7 PE, it's a compelling valuation buy. At 30, it's a riskier bet. So it's better get into undervalued, make money and get out. That's what we did. So you have a lot of option on ETF side, but you have to explore and get the right advisor who can help you out by identifying these opportunities which are mispriced.
So essentially, if I had to understand what you're saying, that the market typically has 2 phases. One is the bull and the bear. During the bull phase, whatever you touch will grow.
Absolutely.
Right?
We have seen after COVID, from 2020 till 2022, we have seen this.
Correct. So whatever you're touching is going to go up. You don't have to think about
300% return,
much, right?
Period.
And right now, when we are in the bear phase, because last year we got 0% returns, you're saying that now is the time to look at quality.
Absolutely,
right?
quality.
You need to take a step back and be like, okay, the market is not moving up as a whole, but can I still identify those mispriced stocks or mispriced industries where I can park my money? And this entire process and analysis is what a financial planner or a financial advisor can do for you.
Absolutely bang on, Sharan. You got it completely right. Also, we believe that these mispriced stocks, ETF within Nifty 200 or ETF, can give you a great opportunity to invest in long run.
Then Amit, you didn't talk anything about REIT funds, or any real estate investment funds. Are you not bullish on the real estate sector of India?
I'm bullish on real estate as of now, but REIT will give you around 7 to 9% return, which is okay. Ultimately, it's all about how much allocation you want to do into it.
Yeah.
If
this is including the yield plus capital appreciation?
Yeah, correct. 7 to 9%. We have seen as a practice, right? But we are bullish on real estate for sure because we made huge money there, as I said, in Noida Expressway.
But that's the past. I'm talking about right now.
As of now, I think everything looks fairly valued to us.
Okay. There's no undervalued real estate.
No, because understand, real estate is closely linked with the IT sector of India. Because most of the people in Gurugram who invested, right, in Noida, in Hyderabad, in Bangalore, they are from IT services. And after AI, IT services are going to take some breather. I'll not say a crash, some breather, right? So if there are lesser number of jobs, it will directly impact real estate.
Interesting.
Right? So it will have a cyclical effect on the real estate cycle of these markets where we made 300% return. If you invest into Noida today, you will not make 300%. I'll be happy if you make 100% return in the next 4 years.
So I have an interesting thing I read recently
So
online.
it's about timing. I always say is invest rightly, switch timely. If you don't switch timely, you will not make money.
So I just read something recently, which I just remembered, that the Grow IPO is coming, right? I think it's going to be listing at $7 billion or something like that. And from the reports, what it suggests that more than 1,000 crore-patis will be made in this IPO out of the employees' ESOPs. Now, there is this tax rule which says that if you are getting this shares from the company, you'll have to pay tax, right? Unless if you sell it and buy real estate. right? If you're buying it as your house, you get to save that capital gains tax. So based on this information, and because the grow is in Bangalore, and all of these 1,000 crore-patis need to save taxes, can we say that there could be some real estate boost in Bangalore because of the sudden inflow of money? How would you assess this?
Honestly, no view on that. I'll be very honest with you. It look very speculative. And I said we are risk averse.
But isn't this like how somebody would
on the
think?
face of it, as you said, looks likely. But I'll refrain from any comments on that line because I don't want to create that. But looks likely the way you said it. But real estate, gold, and even equities are at a very fair valuation, a little overvalued compared to their fundamentals. I think it's a good time to be on cash for some time. Wait for right opportunities, focus on micro themes and micro markets, and make money.
What do you mean by that? Micro themes,
micro
sectors.
markets. For example, in last 10 years, Ahmedabad I made only 50%, which is less than 4% CAGR.
We're talking about real estate, right?
Real estate.
Okay.
Even in stock market. For example, there are a lot of things which has done up too fast. And there are some themes which are not perform well. So it's better you focus on micro themes and micro markets. So when it comes to real estate, micro markets. When it comes to stock market, comes to micro themes. For example, I said PSU is a good theme for us. We are bullish on this. We are bullish on IT from a price point of view. I think बहुत ज़्यादा नीचे नहीं जाएगा यहाँ से. So IT, we are pretty bullish on FMCG at the current levels. So these are the micro themes on which you can get a safeguard. If you are even more conservative, you can get ETF of these sectors rather than getting into a particular stock and make money in the longer run with a lot of safety.
Right.
Safety comes first because what happened in the stock market, if you buy a stock and if it falls 10%, you're gone.
Why?
Because then you will not realize that when to average out. If it is a large cap, good enough. If it's a mid cap and a small cap, and you, for example, you have a 1 crore rupee portfolio, you invested 10 lakh rupee into a small cap stock. If it goes down by 20% in a circuit because of some news, will you have a courage to average it out when you invested 10 lakh rupees into it?
When you mean average it out, you mean like
put more money
into it. Okay.
Difficult because you have a company called Dream Folk Services.
Right.
The Fusion Microfinance, the company in which even World Bank has invested, has done some partnership. The stock of Fusion Microfinance has fallen from 500 rupees to 170 rupees.
This is that same company which is in charge of airport lounges, the Dream Folk.
That Dream Folk, yeah.
Dream Folk.
That has fallen down from 800 to 100.
Correct. I think Adani came and disrupted
but Adani came and disrupted at 300. From 800 to 300, it was without Adani.
It was already in a distress state.
Correct. So in small cap and micro cap, you even don't know when to average out. So it's better that you get into a quality stocks, put higher allocation into quality stocks, and let them grow in a longer period of time rather than taking some speculation. Because one bad stock or two bad stock out of your 10 stock portfolio will dampen your entire portfolio return. So you have to be very choosy about the stock. You should be very careful about the quality of stock. And the pricing on which you are entering in. If you really want to build a robust portfolio that way.
Got it. So basically the macro impacts the company, not the micro.
So what we famously call is that you should choose a company when company is good, but markets are bad. So you are getting a good company at a right price or at a below price.
But right now, as we talk, the market is looking good. And so right now, this is not a good time to invest.
Market, selected in few pockets.
Right.
In few pockets.
Got it. So, Amit, just to summarize this entire discussion on mutual fund investing, what I understood, I'll just summarize everything.
Yeah.
Number one is that do not overcomplicate your portfolio. Pick not more than 4 to 5 mutual funds in your overall portfolio.
Absolutely.
Right? One could be a large cap fund, mid cap, flexi cap. We could have, what other two categories can we have?
I think large cap, mid cap, multi cap. And you can have some ETF.
And some ETFs.
The ETF should be good enough.
Got it. And lastly, just because the market is going up doesn't mean that your mutual fund portfolio is going to go up. It really depends on what are the sectoral allocation that you have done properly and what are the themes that will play out better than the broader market. So sometimes you might get it wrong and you might underperform the broader market. So be very careful with the kind of sectoral allocation happening within your mutual fund so that you're able to beat the benchmark.
100%. And a right weightage. The weightage has to be right because what happened that when you talk about the portfolio, right, unless you got the right stock, but you have not invested enough in that stock, then your portfolio will not perform.
Right.
So right weightage, no one talks about it. And that weightage comes with a lot of conviction and a lot of your homework. Right. So right weightage is equally important as the right stock.
Right.
Just to add to your point.
Right. Perfect. Anything else you would like to add, Amit, beyond whatever I just summarized?
I think we have just summarized it. But only thing is, one thing we missed out probably while summarizing it.
Yeah.
Don't always see the past returns.
Yeah.
Because mutual
You don't even look at past returns.
Absolutely, yeah.
Right.
Because you have to invest into future potential,
Right.
not in the past.
Right.
Even the MFI says it in the disclaimer. The past performance does not guarantee the future performance. So please identify the potential upside of your portfolio rather than seeing that which scheme has done what in the past. The market works in cycles, right? For 3 years, you will find a different cycle. 3 years, you will find a different cycle. And if you're investing in the peak of the cycle,
right,
then your time correction and price correction will test your patience big time. And
Correct.
most of the people don't have that patience.
Right.
Right? So get in the right curve, get in the right time, and make money in the longer run and stick with the quality.
Perfect. So thank you so much for watching till the end, and would love to hear your feedback in the comment section on what was your entire learning experience, what was your favorite parts, and please drop down any future guests that you want us to bring for this podcast so that we bring out their learnings to you right to your home. Thank you so much, and I'll see you in the next one. Before you go, guys, if this episode gave you even one insight that made you think differently about money, don't just keep it to yourself. Share it with your friend or family member who could use it too. And if it sparked a new thought or even made you disagree with me, drop a comment below and tell me why. Your critique helps me make these conversations sharper and more useful for you. As long as you have me subscribed, I'll make sure that you walk away with at least one new thing every Wednesday.